What's up, you guys? Welcome back to my channel. This is Humphrey here, and today I have a special announcement. Today's my 100th video here on YouTube, so that's 100 videos in about a year, and I appreciate everybody watching so far. So I don't really know how to celebrate 100 videos, so I thought I would just make some commentary on the market so far, and hopefully you enjoy this video. So right now, things are going pretty good in the market. I mean, the Nasdaq is trading at over 13,900 points, and back in March of 2020, it was trading for around 6,800. The S&P 500, very similar story. It's trading at over 3,900 right now, but back in March of 2020, it was trading for 2,237. So right now, we're partying like it's 1999. Everything's going really well in the markets. A lot of money is flowing through the economy because of all the relief bills happening. And we have a lot of Americans stuck at home on their smartphones doing exactly what they should be doing, which is trading GameStop to the moon. So naturally, the environment that we're in today draws a lot of comparisons to the dot-com bubble of 2000. And that got me curious in and of itself, so I actually did some research and I put together this video for you guys. So today we're going to discuss exactly that, which is how we got to the dot-com bubble, how exactly that bubble burst, and if there are any similarities and differences to what we're seeing today. Now, before we start, make sure you actually burst the like buttons bubble, because in order to do that, you have to make it turn blue, and then the bubble will burst and everything will be back to normal. That was a bad joke. I didn't even really get that joke, but with that being said, let's talk about the dot-com bubble. So back in the 90s, the internet was a pretty new revelation. I remember sitting in 5th grade on Netscape Navigator going on yahooligans.com, which at the time was just a kid's version of yahoo.com. I remember it would take over 10 minutes to download a photo, and the whole web was just a new world to me, and I was just happy to not be doing typing classes anymore and actually doing something different, which was searching things online. Now, at the same time, while I was sitting in 5th grade, in fact, interest rates in the United States became relatively lower, which meant that after the success of a few internet companies, entrepreneurs started to kind of notice how much money people were making with all of these new internet companies and decided to make their own. Since money now became a lot easier to get a hold of because the interest rates were lower, then that's what you saw was a lot of loans were being taken out to basically create more internet companies. So in the mid-90s, Netscape actually went public, and if you guys don't know what Netscape is, it's basically like the 90s version of Internet Explorer or Google Chrome. On their IPO day, just that one day alone, their initial shares were priced at $28, but they actually closed in trading at around $58 at the end of the first day. Now, keep in mind, before this IPO actually happened, this was a pretty rare occurrence. Now, I know these days we see IPOs basically double in the first day pretty regularly, but back then that was a pretty rare occurrence and people definitely took notice. So because investors started to notice this, a lot more internet companies were sprouting up, and they all had this promise of changing the world, and the market just seemed infinitely large at the time. It was soon that these businesses started to not even care about making a sustainable business model or actually making profits. All they really needed to do was prove that they had sales and had growth potential, and a lot of investors would just throw money at them. Investors started to ignore traditional metrics for evaluating companies and just wanted to throw money at whatever could grow the fastest. So now you combine the fact that many people are getting rich off of creating internet companies, 2, you have a really low interest rate environment, and 3, you have the average retail trader speculating on all of these internet companies via the market. From 1995 to 2000, the Nasdaq actually rose over 400%. And things were really good. I mean, right before 2000, the Fed chairman actually lowered the interest rate even further so that he could basically spur more economic activity because he was afraid of the impending Y2K bug. If you don't know what the Y2K bug is, let me try to explain it for you off the top of my head really quick. I don't know if I know the exact details correctly, but the financial system at the time was built on a ledger that was stored in computers. A lot of these ledgers had years that ended in just 2 digits instead of 4 digits. So basically, instead of 1999, they ended in the digits 99. It was theorized that when the year 2000 came, that the computers wouldn't know what to do with the fact that, the year read 00, and that all the banking system and financial systems would crash. That actually did not end up happening. So when the actual year 2000 came, the banking system and financial system were fine. But as a result, the Fed chairman had lowered the interest rates prior leading up to 2000, and that was causing a lot of more extra money in the economy. So after the Y2K problem was not really a problem, the chairman at the time of the Fed, Alan Greenspan, decided he wanted to aggressively raise interest rates in February of 2000. Now, that brought some volatility in the markets at the time from February to March, but the actual bubble started to burst on March 13, 2000, when Japan had announced that they entered a recession. It was pretty downhill from there, and on April 14th, 2000, that's when the Nasdaq actually dropped the most. It actually fell 9% in a single day, and it ended the week week down 25%. That whole year, we saw a complete sell-off of a lot of different equities, especially tech stocks in the Nasdaq Composite. Now, here's an interesting bookend to the year 2000. On November 9th, 2000, Pets.com, which had only gone public less than 9 months earlier, actually filed for bankruptcy. By that time, most internet stocks had actually declined in value of over 75% from their all-time highs. So that was basically the dot-com bubble. It was a really exciting period from the years 1995 to 2000, basically marked by a lot of exuberance and a lot of people just buying, thinking that everything was just going to keep going up and up and up. Now, that's kind of similar to what's going on today, so let's quickly talk about the similarities and differences from today to the year 2000. So in terms of similarities, let's talk about those first. There are a few, and one is that the IPO market for some select companies is very similar to what we were seeing pre-2000. For example, Airbnb opened at a price double to what its actually share prices were supposed to be offered at on the opening day. Similar thing happened with Bumble. They were up nearly 2x of what their share prices were supposed to be offered at as well. And you have a lot of companies going public through what's called a SPAC these days, and they're seeing a pop whenever a merger is announced. When it comes to SPACs especially, I'm seeing a certain type of FOMO from investors, and it just seems like nobody cares what the SPAC actually does, or if they're profitable, or if they even have a product coming out. If they hear the word SPAC, they're investing. For those of you that don't know what a SPAC is a special purpose acquisition company. So in a SPAC, a bunch of investors get together, and their whole purpose is to create a public company that has no operations at all. Its sole purpose is to acquire a private company and then take it public. By going public this way, the private company actually avoids going through the traditional listing process of an IPO, which means that they can go public with little SEC involvement versus if you go with a traditional process, the SEC scrutinizes the deal and actually vets the deal for the public. Now, this is kind of a double-edged sword because now a lot of not so great companies could be potentially going public as long as maybe there's some promise of a product that they're going to deliver. Case in point was Nikola Motors of last year. So last year, Nikola Motors announced that they had a new electric freight truck on the way. When they started to announce that they were taking pre-orders for their new electric vehicle, or the electric freight truck as it was, their share prices actually rose from around 15 or 20 bucks a share all the way up to $80 a share. But that share price actually came crashing right back down to earth after a short interest report was published saying that Nikola was built on intricate fraud, and actually that resulted in the chairman and the CEO resigning. So that was a case where if we didn't see that short interest report come out and another firm actually do some due diligence on Nikola Motors, we actually could see Nikola Motors still be trading at a pretty high level today. Now, I think this is actually a microcosm of some of the other SPACs and other behavior that we're seeing in the market. Is basically if somebody sees a hot company coming up, they're not really doing their homework on those companies and they're just investing in those companies a little bit blindly. We kind of saw some of that exuberance with the short squeeze stocks of GameStop and AMC a little bit earlier this year as well. The second similarity that we have right now to the year 2000 is that interest rates are really, really low. Interest rates were around 4.25% in the year 2000, which was very low for them at the time. And for us, it's 0.25% as of right now. And just like I mentioned earlier, that just means it's really cheap to borrow money right now. The third similarity that we're seeing from today to the year 2000 is that the monetary supply is actually increasing pretty rapidly. So with all the money being pumped into the economy right now, we actually saw our money supply increase from $15 trillion at the beginning of 2020 to almost $19.5 trillion at the end of 2020. I didn't mention this earlier, but at the end of 1999, the monetary supply was also increased a lot by the federal chairman at the time, Alan Greenspan, because of the impending Y2K. So those are the similarities from now till the year 2000, but let's actually talk about the differences and why today's environment might be a little bit different. One of the differences is that the same bubbling factors in the year 2000 are actually not happening to some of the bigger tech companies that we have today. For example, the largest of the tech stocks back in the year 2000 were trading at a much higher valuation proportionally to the mega cap tech stocks that we see today, like Facebook, Amazon, Microsoft, Netflix, and Google. The craziness this time around is concentrated in a few different types of pockets, most notably cryptocurrency, maybe even Tesla, and a lot of the SPACs that are going around these days. Things are certainly expensive, but there's kind of an expectation that consumption and overall retail spending is going to go up as the vaccine rolls out later this year. The other difference is back in the year 2000, the interest rate was actually raised aggressively to around 6.5%, which means investors could actually get a decent return elsewhere besides the stock market. Investors at the time who didn't want to go into stocks could just easily take out their money out of stocks into bonds or maybe even CDs fees offered at a bank. Now, since the interest rate in the current environment is around close to 0 or 0.25%, and it hasn't been close to 5% in the last 14 years, well, investors these days have really nowhere else to go except maybe alternative assets like cryptocurrencies. Real estate existed back in the year 2000 as it does today, so that's always one place where your money could be shifted to. If you're not into the markets, you could go into real estate. However, if you don't want your cash just sitting in the bank losing value, there's not many other places where your cash could go that's actually making you a return. So there are parts of the market that resemble the 2000.com era bubbles, but there are a lot of differences as well. So how should you be thinking about this year? Let's talk about that. So there's a lot of sage advice from a lot of smarter people about how you should be thinking about this year moving forward. The first being that if you prematurely pull your money out of the market, you could just be shooting yourself in the foot. Even if we're in a bubble right now, we actually don't know when this bubble will actually burst. It could be as soon as tomorrow, or it could be 2 or 3 years from now. We just don't know. There's a few good quotes from prominent investors that I really like that I'll pull up on the screen right now. And the first one's actually from Peter Lynch, who's a legendary investor. He says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has actually been lost in corrections themselves. Similarly, Warren Buffett has said, forecasts usually tell us more about the forecaster than of our future. All of these investors acknowledge that we don't know what's going to happen in the market, but as long as you stay in the market and have a long-term plan, you're going to be okay. All right, so let's talk about what you should do or what things you should be thinking of in this current environment. First, we can never rule out a 10 to 20% move in the market. So if that ever happens, if the market ever tanks 20%, you'll probably find me and other similar value type investors actually buying more into the market at that time. It's one of the reasons why I have some of my portfolio sitting in cash for some certain market opportunities, especially in the event of a correction. Second, if you are worried about a bubble bursting, now's a really good time to get your financial foundation squared away. You should have your emergency fund prepared, so that's 3 to 6 months of living expenses, and maybe you can even have a fund for opportunities if the market actually corrects 20% or more. Next, you should diversify your investments as much as you can, especially if you think something bad is going to happen in the market. It's always good to have some diversification. So like I said earlier, maybe put some of your money into cryptocurrencies, some of your money into real estate, some into alternative assets like gold and silver. Lastly, if you can invest without emotion and try to systematically approach investing and always have a plan, then you're always going to be ready no matter the situation. That could involve dollar cost averaging into the market. So on a certain day, every single month, you invest a small amount. Or it could just be leaving your money in a passive index fund and not checking it all the time. All right, guys, I hope this video helped you understand the similarities and differences between the dot-com era crash and bubble versus what we're in today. Let me know what you guys think of the market that we're in today in the comment section below. I'd love to hear your input. As always, make sure to like the video and subscribe to my channel for more personal finance and investing content in the future. If you'd like 10 bucks worth of free stock when you download public.com, use the link in my description below for that. Lastly, if you'd like to see what I'm investing in and my stock portfolio, it's all available in my Patreon. And thank you to all my Patreon supporters. I appreciate you guys being here. I'll see you guys in the next video. Peace.